Welcome to Hidden Finance, the channel where economics and finance reveal their most hidden secrets. Today, we'll uncover a new mystery that has shaped global markets and influenced the economy. In 2008, all the major American banks were on the brink of collapse, panic was widespread, and yet there was one person who remained calm. Jpmorgan Chase was becoming stronger than ever before, a success driven by the insight of a single individual, a rather unique character. Today we're talking about him, the most powerful banker in the United States, Jamie Dimon. If you've never heard of him, know that his story is practically made for the big screen. He's not your typical boring businessman in a suit and tie, though yes, he does wear a suit and tie, of course. But Jamie Dimon is a unique personality. Jamie Dimon was born in New York in 1956. His father, Theodore Dimon, was a respected broker of Greek descent. Jamie's family was well off, to put it mildly, so much so that a few years after his birth, they moved to Manhattan's exclusive Upper East Side. By the age of 9, Jamie told his father that when he grew up, he would become incredibly wealthy. Young Jamie had a lot of confidence in himself. He was an ace in sports, successful with the girls, and had many friends. He was the typical American boy of that era. Those who knew him called him Mad Dog, someone who feared nothing and no one, especially not afraid to go against prevailing conventions. It's easy to do that when you have money on your side. School wasn't his strong suit. After graduation, he was rejected by Brown University in Providence. So, Dimon went to study at Tufts University in Boston. After earning his degree in economics, he was hired by Shearson, a banking group whose president was Sandy Weill. Will was already one of America's most influential financiers and a friend of Dimon's parents, bringing us back to the importance of origins. It's not far-fetched to think that he might have had some help at the start. Despite entering the world of finance, Dimon's career didn't seem promising. After a short stint at Shearson, Dimon decided he didn't want to remain just a mediocre employee for the rest of his life, especially not with a job he got through family connections. So, he decided to gain experience. He worked for 2 years at Boston Consulting Group, one of the most important consulting firms in the world, and meanwhile he began to study seriously. Finally, in 1980, he managed to get accepted to none other than Harvard Business School, one of the most prestigious and selective colleges in the world. Dimon graduated with a master's in business administration in 1982, and this time, it was a different story. The young man now had all the qualifications to make it big. Experience, an academic degree, and the right connections. Offers began pouring in from major Wall Street banks, giants like Goldman Sachs, Lehman Brothers, which was still doing well back then, and Morgan Stanley. However, Dimon declined all offers because he had already received one that tempted him more. Sandy Weill had asked him to become his personal assistant. Economically speaking, the offer wasn't that attractive, at least according to Dimon himself in his future memoirs, but Weill was a giant in finance. In 1981, Shearson was acquired for $915 million by American Express, and Weill himself became president of American Express. Working for him, even just as an assistant, was an excellent opportunity to launch his career, to get noticed by those who mattered. And as we know, Dimon succeeded brilliantly. 4 years passed, and Jamie Dimon had become Sandy Weill's shadow, following him everywhere, doing whatever needed to be done. This is evident in an episode that took place in 1985. That year, Weill proposed to the American Express Board of Directors to sell Fireman's Fund, but the board opposed the idea, saying it was too important. Weill, however, took it personally and left American Express. What did Dimon do at that point? He was even asked to stay, but he chose to continue following his mentor. Mark this as a crucial event. Weill, meanwhile, wanted to return to the pinnacle of Wall Street. To do that, he needed a new starting point. He had plenty of money and many contacts. The plan was to acquire a small, struggling bank, restructure it, revive it, and eventually sell it at a higher price. But it wasn't Weill who identified the golden opportunity. It was Jamie Dimon. Dimon identified Commercial Credit, a financial institution in Baltimore that was struggling. Commercial Credit was owned by Control Data Corporation, a large conglomerate involved in technology and data processing. Weil and Dimon convinced Control Data Corporation to sell 80% of commercial credit. Will himself personally invested $7 million, while Dimon put all his assets on the line, amounting to $25,000 at the time. Once they acquired commercial credit, Weil immediately appointed Dimon as Chief Financial Officer, a new role for Dimon, but one perfect for his skills and personality. He knew exactly what to do: cut costs and eliminate unnecessary expenses without mercy, if necessary. For Dimon, commercial credit had too many branches and employees, about 4,600. Like the shark he was, he immediately began making layoffs. Commercial credit owned 21% of a brokerage firm in Minneapolis, an asset Dimon could easily liquidate to generate cash. In a short time, Weil and Dimon restructured commercial credit, making it resilient to any possible shocks. So much so that during Black Monday in 1987, the bank withstood the effects of the crisis without any problems, unlike most other banks. They had created an anti-fragile system. Many other financial institutions, however, did not fare as well, and even large banks found themselves in trouble. But what was a crisis for everyone else was a golden opportunity for Dimon and Weil. They could exploit the weaknesses of these banks, acquire them, and then set them in order, as they had done with commercial credit. So, after Black Monday, Weil and Dimon realized it was time to act. In 1988, commercial credit acquired the insurance company Primerica, investing $1.7 billion and even adopting its name, as it was a stronger brand. 5 years later, in 1993, Primerica expanded even further by completing a $4 billion merger with Travelers, the most important insurance company at the time. So, commercial credit, which had become Primerica, now changed its name again to Travelers Group. With each new acquisition or merger, Dimon took charge of streamlining costs and turning institutions acquired with deeply negative balances back into profitability. He did this through cuts and reorganizations. In other words, Dimon aimed to enhance the efficiency of the most profitable resources and eliminate anything that wasn't working. But as Dimon grew, the duo began to have problems. The final act of Weil and Dimon as a duo came in 1998, when Travelers Group merged with Citicorp, a merger worth about $70 billion. This merger created the largest banking colossus in America and the world, giving birth to Citigroup, which would become one of the most important entities in the global financial landscape. The New York Times called it the world's largest financial services company. Dimon, already known as one of the most skilled financial managers around, became president of Citigroup. Everyone assumed he was Weil's heir apparent. So, Dimon was just a step away from becoming CEO of America's largest bank. However, something went wrong. In November 1998, Weil asked him to resign. It was the talk of the moment, a surprise to everyone. For a long time, people debated the reasons for this departure, which came shortly after a corporate retreat. Some said it was due to differences with Weil over strategy. Others suggested Dimon was fired because of his bad relationship with Weil's daughter, Jessica. Jessica had been hired a year earlier at one of their companies, but it seems Dimon did not consider her suitable for that role. Whatever the truth, Dimon suddenly resigned and was left without a job. But as we've seen, he wasn't one to sit idle. The story he is remembered for today begins at this very moment. Jamie Dimon was forced to leave Citigroup and was out of a job, sure, but this didn't mean he was in trouble. Until 1998, he had earned $50,000 a year and received a $30 million severance package. By the late 1990s, his wealth was around $100 million. He didn't want to stay idle, and above all, he wanted to get back at Weil. After all, Weil had ousted him after more than 10 years of working together. Of course, there was no shortage of job offers at this point. He was contacted by British Barclays, George Soros's fund, and even Amazon, which was still relatively small in the late 1990s. Dimon eventually accepted the role of CEO at Bank One, then the fifth largest banking conglomerate in America. But managing it in 1999 would have been almost an impossible challenge. At that time, the group was in serious financial trouble, mainly due to customers leaving because the services had become very outdated. And what did Dimon do? He did what he always did. He started by laying off thousands of employees to cut costs, replaced nearly the entire management team, eliminated expenses like corporate cell phones, cars, and magazine subscriptions, and heavily invested in a new customer service initiative. With these moves, Dimon wanted to fully implement his theory of the fortress balance sheet. In simple terms, for Dimon, a fortress balance sheet is a situation where a bank is organized to always have ample liquidity for investments and protection against any unforeseen events. The point of his approach is to avoid losses that could lead to a collapse. The first tangible result of his work was the $500 million cut in the annual costs of the group's credit card division. However, Dimon was aiming for a much bigger prize. Thanks to this process, the bank had successfully recovered. It was in 2004 that Bank One, revitalized by Dimon, was acquired by Jpmorgan Chase, one of the most powerful banks in the United States and one of the oldest, founded in 1871. With this merger, the group became a giant. The newly formed banking group maintained the name of Jpmorgan Chase, and Dimon was appointed its CEO. Jpmorgan Chase was now a colossus, even more so than Citigroup, which in the meantime had been severely damaged by poor management choices. Dimon was finally back at the top of Wall Street, where he could show everyone what he was capable of. The problem was that he couldn't make any mistakes this time, and as a first step, Dimon continued to cut costs, including half of the management team. He even replaced the CFO. He continued to pursue his strategy of building a fortress balance sheet, and here, too, Dimon knew exactly what to do. He immediately realized the inherent risk in the subprime mortgage sector, unlike many other investment banks that heavily used them to quickly make money. It was a very high-risk sector. He had already had experience with derivatives, a type of financial product. In the years preceding the 2008 crisis, many investment banks and institutional funds began using derivatives tied to subprime mortgages, but they carried very high risk. Dimon decided to reduce Jpmorgan Chase's exposure to these products by cutting $12 billion of subprime investments in 2006. It may seem like a lot, but consider that at that time, Citigroup had exposure to $55 billion in derivatives tied to subprime mortgages. When the financial markets collapsed in 2007, Citigroup's losses skyrocketed. By the following year, Jpmorgan Chase had over $6 billion in profits and was the second most profitable company in the S&P 500. Jamie Dimon's strategy was starting to show its worth. It was now 2008, and the financial crisis had hit hard. But Dimon was not worried because he knew that Jpmorgan Chase had not put itself at risk. In fact, the bank emerged stronger than ever, thanks to the fortress balance sheet. Jpmorgan Chase's liquidity allowed it to weather the storm and even take advantage of it. When Bear Stearns, one of Wall Street's most important investment banks, went bankrupt, Dimon was contacted by the U.S. government, asking him to acquire it. He agreed, taking on the task of reorganizing the company and saving the jobs of thousands of employees. The bank's assets were purchased at a very low price, consolidating Jpmorgan Chase's position. Just a few months later, Jpmorgan Chase also acquired Washington Mutual, another institution in crisis. Thanks to these acquisitions, the group grew even larger and more solid. Dimon also took advantage of his influence to acquire a network of connections within the American government, which recognized him as one of the best banking managers. Today, Jpmorgan Chase is the largest bank in the United States, with assets exceeding $3 trillion and a market capitalization of over $560 billion. This makes it one of the most important companies in the world. Jamie Dimon is now considered one of the most influential bankers globally, often consulted by the U.S. government on economic and financial matters. His story is an extraordinary example of leadership, intuition, and resilience. From his early determination to become wealthy to his ability to lead a bank through one of the worst financial crises in history, Dimon has shown that success depends not just on connections or initial resources, but on the ability to make bold decisions and remain calm under pressure. In an ever-changing financial world, Jamie Dimon remains a beacon of stability and a testament to the power of preparation and long-term strategy. His story is not just a personal success journey, but a model of how leadership can make a difference in times of crisis. If you enjoyed the video, leave a like and subscribe so you don't miss the next mysteries of the economic world. But what's your opinion? Share it in the comments.